I've been in the alternative investment space for nearly 25 years, and I've watched hundreds of real estate syndications launch. Some made people really wealthy, and some are crashing and burning as we speak. Have you ever invested in a real estate syndication only to feel like the deal just wasn't working out the way it was supposed to? Or maybe, unfortunately, you are one of those that have invested in a failing deal and you just learned that your capital's gone. If that's the case, you're not alone. Over the last few years, I've talked to countless limited partners, smart, accredited investors who lost their money or they got stuck in deals simply because of avoidable mistakes. And no matter what these sponsors are telling you and the excuses you're hearing, yes, these mistakes are avoidable. You can't predict interest rates, but you can certainly prepare for anything. So in this video, I'm going to walk you through the 7 biggest mistakes that LPs are making. And they've unfortunately made them in the past, but we've got to learn from this. And more importantly, I want to show you how you can avoid those mistakes again. Now, in essence, these mistakes should inform a set of principles that you develop around your investing. And those principles are going to help you stay out of bad deals. So stick around, because if you've ever been burned by a deal or you're about to wire a large amount of money into one of these syndications, this could save you 6 or 7 figures over your investing career. Now, if you're new to this world of alternative investments, I've created a masterclass. It's perfect for the new investor, and it's going to help bring you up to speed. Now, if we haven't met, my name is Kent Leach. I've been investing in alternative real estate deals for well over 20 years. First, it was hands-on. I flipped houses. I had some rental properties and rehabs. But now I run a private fund, and I just invest passively along LPs just like you. I've seen incredible wins and complete disasters. Now, what I'm sharing today comes directly from watching dozens of deals play out in real time. So let's dive right into it. Mistake number 1, and these are in no particular order, but it's chasing IRR and instead of chasing real returns. So here's the trap. IRR looks sexy. It looks great on that pitch deck. It's the number every syndicator puts in bold on that first page of their deck. But IRR can really be manipulated. So you have to understand that. You can do things to manipulate it, like shortening the hold or assuming an aggressive refinance in the future, or you push exit valuations. Suddenly you've got this 20% IRR, but the deal collapses under real world conditions. Now, I've seen investors chase those projections, and they only end up with no distributions or a capital call or an account that never returns. So the fix is you just can't look at IRR. You got to look at other factors, and there's so many, but equity multiple is one. Cash flow is huge. We're going to dive into that soon. And the debt structure has to be analyzed as well. And you've got to ask, what's my real dollar for dollar return, and how much risk am I taking to get it? Now, mistake number 2 has to be not vetting the sponsor deeply enough. I hear it all the time, and I get tired of saying it, but it's true. A good sponsor can save a mediocre deal, and a bad sponsor can ruin the best deal you'll ever see. Too many LPs are getting comfortable with a slick presentation and a personality and the confident operator. But have you checked their track record? Have you checked it through multiple market cycles? Do they have a strong team, or is it a one-person show and one guy wearing every hat? Do they have a plan for when the proverbial what hits the fan, or not just when things are going right? And here's one thing you may not have considered. Is there at least 2 principals at the top of this syndication? Because it's a whole lot easier to do stupid when no one is checking you, when no one is running, catching you and keeping you from that. Now, I've sat across the table from sponsors who had beautiful pro formas, but they absolutely lack the ability to execute. That's a recipe for disaster. What's the solution? You've got to make sponsor due diligence your number 1 priority. And you got to ask hard questions. You got to talk to past investors. You've got to be afraid. You got to not be afraid to walk away. And there's too many deals out there. You don't have to be somebody's guinea pig. Okay. Mistake number 3, it's taking excessive risk without an equivalent return. Yeah. Here's the truth. There are great high-risk deals and terrible high-risk deals. The problem comes when LPs jump into a risky project like a ground-up luxury development, and they're not being compensated for that risk. Honestly, this has been kind of a pet peeve of mine with some of the build to rent deals I'm seeing. Now, if you're going to take on that development risk and that lease up risk and the debt risk, construction loan, and all you're getting is a return that's the same IRR as a stabilized multifamily, I'm sorry, that's just not smart investing. The fix, well, every time you look at a deal, you've got to ask, am I being paid appropriately for this level of risk that I'm taking? Okay, you got to ask that. Mistake number 4 is probably over concentration in one asset class. I see this a lot. Multifamily, multifamily, multifamily. For years, it felt like that was the only thing investors wanted. And even yesterday, I was trying to help someone find a deal for their 1031 exchange, and all they would consider was multifamily. Multifamily is a great investment. It worked brilliantly for nearly 10 years until it didn't. Now, yes, there are still good deals out there, but when rates spiked and rents flattened and debts matured and became due, a lot of these multifamily heavy portfolios got absolutely hammered. So, smart LPs are looking to diversify across multiple asset classes. Things like self storage, mobile home parks, oil and gas, private credit. Each one of these has its own cycle, and diversification gives you the resilience that when one sector suffers or gets squeezed, the other ones will make it. Mistake 5 probably has to be not understanding the debt structures out there. This one has cost people billions of dollars in the last 3 years. Bridge debt, floating rates, weak loan covenants, they all look fine when the market's rising, but when the rates doubled, these same loans just crushed deals. Refinances that should have happened never materialized. So, what's the solution? You've always got to be asking those sponsors about the debt. You've got to make them explain. Is it fixed? Is it floating? What's the maturity look like? What happens if the rate moves 200 basis points? If your sponsor can't give you a straight answer to that question, that's a huge red flag. You've got to become an expert on debt. Heck, maybe you should even consider becoming the bank on a few deals. And that leads us into the next big mistake I'm seeing. Mistake number 6 is no base layer of private credit in a portfolio. Now, this is interesting. Something most LPs are overlooking. Your portfolio needs a foundation, and too many investors go all in on equity deals, hoping for big multiples, but they're shocked when the cash flow dries up. And cash flow is key for velocity in your portfolio. And the velocity of capital is like rocket fuel for growth. That's when private credit comes in. These are debt deals, especially amortizing loans. These deals return capital faster and they smooth out the volatility in your portfolio. So instead of waiting 5 to 7 years for an equity pop, you actually start seeing some principal come back in year 1. Now, without that base, investors end up overexposed to deals that just simply don't cash flow enough. And they get stuck. Everything's deployed and no capital is flowing back for new opportunities. So it just stands to reason that the last mistake centers around cash flow. Mistake number 7 absolutely is investing without considering cash flow first. At the end of the day, IRR is just a spreadsheet number. Cash flow is what pays your bills and funds your lifestyle and gives you freedom. So if you're just growing a nest egg, or a cash flow is it's a barometer that tells you the overall health of your portfolio. And too many LPs are chasing pro forma wealth and they're ignoring actual distributions. I've watched investors brag about the paper IRRs and they're not even receiving a dollar into their bank account. The solution, you've got to prioritize cash flow. And if a deal can't produce steady distributions, you've got to ask why. Sometimes it's worth it, but most of the time you're going to be better off with something that pays you now, not just someday. But you got to be careful because some deals, they'll actually raise extra capital up front just to hand it back to you and call it cash flow. Now, what we're looking for is true organic cash flow, not that fake stuff. So let's recap all these. You can't chase IRR, okay? You've got to vet that sponsor harder than the deal itself. You've got to learn to match risk with the return, okay? You've got to diversify your portfolio, but beyond one simple asset class. You've got to make an effort to understand debt. You got to build a base layer with private credit, and you've really got to change your mindset to think cash flow first. Now, if you avoid these 7 mistakes, you're going to put yourself miles ahead of the average LP investor. And this is exactly what I help accredited investors do through my fund. We avoid the landmines, we source better deals, and we build portfolios that are honestly built to last. So if you want to take the next step and see if the opportunities I'm investing in right now might fit your portfolio, I'd absolutely love to talk to you. If you'll click the link below, we can book a call and we'll have a simple conversation to see if we're a fit for you and if the deals I'm seeing right now align with your goals. Hey, thanks for watching this video, and I'll see you on the next one.